Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm here with a video which is going to try to explain the difference between dividend investing, dividend growth investing and growth investing by using BCG boxes. And you might ask, what are BCG boxes? Well, it are in fact the boxes from the Boston Consulting Group that they used in their growth share matrix to evaluate investments in a company's portfolio. So originally you had Alan Zacon who drew up the scheme, and then in 1970 you had Bruce Henderson who wrote the book The Product Portfolio to explain how they used the growth share matrix. And that made actually the BCG boxes quite popular, and it divided the investments up in 4 different types or boxes. So you had the first box, the cash cows, then you had the stars, then you had the question marks, and then you had the dogs. And this is in fact how it was drawn up. So here you have the y-axis, the market growth from low to high, and then you had the market share axis with from low to high, and low are the dogs, low high are the question marks, high low are the cash cows, and high are the stars. So if you look at it like this, so cash cows with high market share and a low growth rate, they don't cost a lot for the company and they promise a high return. And what the Boston Consultant Group advised the companies was to milk them. And if you look at this as an investor point, you can maybe think the way I do, and for me it sounds like dividend investing to me. So then you had the stars, which have a high market share and a high growth rate. They devour money as well, so they reinvest a lot of the cash that they generate again in their own firm in order to keep growing as they do. But they can become cash cows, and I think this last sentence is more a case of the fact that it was in the 1970s and they liked dividend investing more. So they advised companies to invest into those stars in order that those stars could become a cash cow later on for the company. And for me, investing into stars sounds like growth investing. So eventually, if you have a star and it reaches maturity, then it can become a cash cow, which is giving out dividends and with a higher growth rate at first, but then later on in its life cycle, it's a true dividend cash cow, like for example Nestle. And yeah, in the 70s, 60s, 70s, they like dividend investing more because yeah, it was just more the time for enjoying dividends on the stock market. Now people like growth investing more just because the past 10 years you had a huge bull run on the market, just interrupted by a few minor crashes in fact. So yeah, it's just the mindset of the time back then. But I like dividend investing still. I grew up in the 80s, 90s, and I started investing in the 90s. Then I had the dot-com crash happening. I also had the financial crisis happening, so that is of course influencing me as well, and that's why I like dividend investing, of course. Then you have the question marks, so they have a low market share, but they grow quite fast. And you can think about those stocks like Palantir and CrowdStrike, which are growing like crazy and have a quite high and Salesforce have a quite high PE ratio right now as well. They need financial support, so probably those companies, they will come to the stock market again and ask for reinvestments. They also do a lot of stock-based compensations, so that's in fact also a kind of financial support. But they can become stars, and that's why a lot of people invest into them because, yeah, who doesn't want to invest into the new Nvidia and become, yeah, wealthy or rich with investing in a new upcoming company? And for the Boston Consulting Group, they said, yeah, it's a question mark what to do with them because they are a question mark. And they do like stars though, so they do say, okay, keep investing into them, and if they go and switch over to a star, that's great. But if they don't, then in fact they are a dog, and then you should, yeah, you should drop them. So they have a low market share, a low growth rate, and then they advise to liquidate them. So get out as an investor when you see a true dog. But as an investor, I would like to turn the matrix around so I have the market share here and not the growth, because then you have the green boxes on top, so the cash calls and the stars. I like that representation as an investor more, and here you then have the market growth. And if you look at then the dividend investing group, then most of the time you are going to invest in companies that are in this region. It's arbitrary where you put those lines. I put them more or less in the half of the dogs and half of the stars, and also 1/4 of the question marks. Because, yeah, you want to invest, of course, in the cash cows, but like the aristocrats and the dividend kings, but it's not all that simple. So sometimes companies go down a bit, or they move again to the stars because they had a rough time, and then they move again to the higher growth after the COVID period. For example, a lot of companies, they were in this region, then they went more or less into this red region, and then when the economy picked back up after the COVID pandemic, they grew quite fast and they became stars again. But that is only going to last for 1, 2, 3 years, and then they will go back to the cash cows. So yeah, it moves. So that's the thing that you need to be aware of. Sometimes they go back to the question marks, and in that time, when you believe in the company, the the stock price is going to go down quite hard. And if you believe in it, you can do quite nice deals. But sometimes those question marks then turn out to be, in fact, dogs. Like, for example, I can say Credit Suisse. They were here, they went down to the question mark. The management turned out to be not that great. They became true dogs and they went bankrupt all the way down here in the corner. So that can happen, and that's why this is just a static representation, but in fact the stock market is always on the move. Then you have the growth investors, and they invest into the stars and in the question marks because they believe that some question marks are going to become stars as well. So they try to invest in this region. Where you put this line, that can fluctuate. You can put it more to the right or more to the left. It's up to you where you put that line, but it's just a depiction for a visual representation. And then when you look at dividend growth investing, then you are in fact investing in this region. So you have a few cash cows, you have a few dogs that have a higher yield and have the potential to move up and take more market growth. You have question marks that can become stars that already are paying out dividends. For me, it's like a company like also in Switzerland. So it's a tech company that they also invest into artificial intelligence, and that company for me has the potential as a question mark to become a star, and it's already paying out dividends as well. So the dividend growth is there, and yeah, it's still in this region, but as a dividend growth investor, also is probably a company that you can check out. And then here, way in the corner, you have the true dogs, and the advice is stay away from that. But this is of course a schematical representation with each box having the same size. For me, the actual stock market looks more like this. You have a lot of question marks on the stock market, so that's why the market is always moving. You have the cash cows here, and you have more cash cows in fact than you have actual stars on the stock market. And then you have the dogs here, which you should be careful of because they can become bankrupt. And once again, dividend investing is in this region, the growth investing is in that region, and the dividend growth investing is still in that region. So that doesn't change, but you see all the regions, all the investing groups, in fact, contain way more question marks that everybody actually wants. And for some people, a company that is in this region for one guy is in this region for a girl. So it all depends on how you look at companies, but yeah, you get the picture. The thing is just stay away from true dogs, and you see the difference. You have a question mark region, which is the buffer in which you are actually able to sell the company before they actually become true dogs, and always run away from true dogs. So whatever strategy you choose, stay away from the true dogs. If you think your company gets close to being one, get out. I'm also not going to hesitate when one of my companies that I invest into the U portfolio is becoming a true dog, I will sell. Signs are cutting of the dividend or fast reducing of the market share. So if you see that happening to your company, get out. And I hear you coming. Hey, BASF and Swatch. So BASF, they already announced their cutting of the dividends before I bought the share, and I'm okay with that. I think it's a really good management decision that they said, okay, we can't maintain the dividend that high, so we are going to lower it. Just yeah, open communication. They also already declared that they are going to increase the buybacks from 2027 on. So for me, that's a good management decision. Swatch, they did it in the past as well, cutting their dividend, so reducing their dividend, not cutting it, but reducing it. And I think the Hayek family is doing a great job there. So although they are the major advantageous persons to receive the dividend, because they of course need the cash as well, just like all the other people that invest into Swatch, but they make the right decision and say, okay, now we have a bit more difficult time, so we reduce the dividend, and once we get past the difficult period, we are going to increase the dividend again. And as you know, Disney, they cut their dividend completely a couple of years ago. A year ago, they started again paying out the dividend. And for me, that's just sometimes a good decision from the management. And I can put it like this: going from the green region, so from the cash cow or the stars region, back into the orange region as a question mark, that will always affect the price of your company, as it raises more question marks. And when more question marks arise, you have more uncertainty, and more uncertainty means a lesser price for your company. If you still believe in your company, then you can buy into it and buy it more cheaply. For Disney, in fact, it was more cheap, but if you looked at the PE ratio, it was always around 80 up to PE of 100, so quite high. The price was low, so from 80 to 100 as well. So if you go off of the PE ratio like I a lot of the time do, then I wouldn't have started investing into Disney. But some people really did it, and now Disney is at around 110, and the streaming business is booming again in of Disney, so they are going to pick up speed again. So those who picked up Disney when there were more question marks, they are in for a great treat for the next few years. And with that being said, I know. So the last thing that I still needed to say was, do not confuse the dogs of this matrix with the dogs of the Dow, because the dogs of the Dow, they overperformed the actual Dow Jones, and I will make another video about that one day, and not in the near future, of course, but I will make a video about the dogs of the Dow, because as a dividend investor, dogs of the Dow are, of course, yeah, something that you should know about. So you can already look it up, but I think certainly this year I will make a video about the dogs of the Dow. And with that being said, thank you for watching to this one. If you liked this kind of content, please subscribe to my YouTube channel. Hit that like button as well. That helps out the channel enormously. And with that being said, thank you for watching, and see you on the next one on my YouTube channel. Bye.